My dear bankers, this is Mohankumar Ramakrishnan, your tutor for this retail credit mastery. Well, to say about myself, I carry 11 years of experience with me in banking in 3 different nationalized banks, starting from Bank of India, India Post Payments Bank, and Bank of Maharashtra. I was so blessed to work in 3 different offices of a bank, right from a branch as rural as Andaman and Nicobar Islands to a circle office which is headquartered at Chennai to a corporate office which was at Delhi. So in this experience of working in 3 offices, I have an overall coverage of multiple verticals. I wish to share my expertise in a very simple form so that you can implement whatever I am teaching in this course in your daily routine. Now the need for a retail credit mastery arose because of various factors, the prime factor being due to EASE 3.0, 4.0 and 5.0 norms, many banks have centralized their loan processing mechanism via CPCs, RACPCs, etc. Now, one processing center is dealing with 20 to 30 branches. Now, this makes the people in the branch less informed about the processing of a retail loan. Branches nowadays act as mere agents of document collection and forwarding the same to their central office. Here the person at the central office will have a thorough knowledge of processing, whereas the person in the branch will have a thorough knowledge of leads counting, NPA recovery, etc. Now how this course is going to be? This is not a static course, number one. Why this is not a static course? Because our industry is evolving day by day. Few months back, the LTV for housing loans was 90%. If the property value was 1 crore, bank can lend up to 90 lakhs. Then RBI came with a change. RBI introduced 3 different types of LTVs. For loans till 30 lakhs, the LTV is 90%. 30 to 75 lakhs, the LTV is 80%. And above 75 lakhs, the LTV is 75%. Now, this is a dynamic change done by the regulator. Like that, our industry will have dynamic changes either by the regulator or by the government or by the market forces, sometimes by individual banks as well. Now, when these changes happens dynamically, we assure you we will introduce a new addendum video or ebook into this course package. So, at a single price of your purchase, you will continue to get lifetime knowledge via this retail credit mastery course. Now here we are going to touch different verticals of a retail loan from top to bottom. By top to bottom I mean it starts from how to scout a loan, what is the checklist of the documents for collecting the necessary inputs for the loan, how to go about the processing, how to do the income eligibility, how to do the asset eligibility, how to do the sanction, how to do the disbursement, how to do the post-sanction monitoring, how to do the end-use verification, and if the loan turns into a non-performing asset, how to do the NPA recovery process. So this A to Z of a loan processing will be explained in separate headers for housing loan, loan against property, vehicle loan, loan against rental discount, loan against paper securities, loan against fixed deposits, personal loan, and education loan. Now, all these loans are already defined as a circular by your respective banks. Then what input or what catalyze activity this course is going to do? This course is going to explain you why certain things are mentioned in the circular of your banks. When you understand the why for each and every category of inputs mentioned in your circular, as a banker, you get thorough domain knowledge. And when a customer asks you the need for a particular document, you can convince him as well. So like this, there are many inherent things mentioned in the circular of your individual banks. Your learning and development vertical of your respective banks would have supplied you 1 pages for certain special credit schemes as well. In this course, we will teach you what is the actual sanctity behind those circulars, why it is being sought, and what role it plays in determining the eligibility of a retail loan customer. Now let me explain you why retail loan is considered as a darling of all the loans. The reasons are quite simple. The first and foremost reason is retail lending is carried out based on documents of the past. By documents of the past, I mean your previous ITRs, salary which was already credited, income tax that is already filed. Now, this past data will give you a solid proof of the borrower's income. Whereas SME lending or large corporate lending is done based on future projections. How much year-on-year growth the company will get next year. But whatever is promised for the future, there is an element of uncertainty attached to it. This makes the lending as more safer than the actual corporate lending. Second thing is liquidity. Now, the liquidity of a loan, I mean, suppose if the loan becomes an NPA, you can very much liquidate the property of a retail loan compared to the stocks of a corporate loan. And number 3 is profitability. The audience of a retail loan are very wider compared to the audience of a SME or a corporate loan. Imagine the number of employees we have in the country and the number of business owners we have in the country. You have plenty of people to lend. When you have plenty of people to lend, your risk is getting mitigated. Instead of giving 100 crore to a single company, as a banker, I will give 1 crore to 100 individuals. I believe 100 housing loans are much safer than a one corporate loan of 100 crores. In this area, we have risk mitigation, we have safety, we have liquidity. Hence, retail loan is considered as a darling of the masses. The last area in an angle of ALCO committee, the asset liability committee, a retail loan has a varied amount of time period. Say for example, a jewel loan has 1 year repayment period. A vehicle loan will have a maximum repayment period of 7 years. Education loan has a repayment period of 15 years. Housing loan has a repayment period of 30 years. Now here we deploy our deposits into various buckets of 1 year, of 5 year, of 7 year, of 15 year, of 30 year. So at each and every end time, I get my money back if it is a standard account. Here I have the option of distributing my money into multiple time buckets. So this is one major feature when it comes to ALCO, Asset Liability Committee, because in order to match the liability and asset at different time intervals, retail loan is an ideal tool. In terms of risk provisions, RBI has given clear-cut guidelines on what approach has to be followed in different types of risk in a bank. Basically, the risk of any bank can be categorized under 3 categories: credit risk, operation risk, and market risk. In credit risk, RBI recommends the usage of standardized approach. In standardized approach, each and every kind of exposure is given a particular risk weight. You might have heard about the word called risk-weighted assets. A jewel loan will have a low risk weight asset, whereas a loan to a NBFC will have a high risk weight. Whatever the exposure a bank has, it will be netted. What does net exposure means? Gross exposure minus provisions. Over the net exposure, these risk ratios will be multiplied. With that, the total risk-weighted assets of a bank will be calculated. Now, when you have more of retail exposure and less of corporate exposure, your total risk-weighted assets will have a low figure. When your total risk-weighted assets is of a low figure, then obviously your bank will have higher capital adequacy ratio. Thereby, it meets the Basel III norms. So this is one more reason why banks advocate for more retail loan canvassings from the branch end.